In late May 2026, U.S. military forces launched airstrikes near the Strait of Hormuz, one of the world's most critical oil shipping lanes. Global financial markets immediately registered the shock. Investors typically flock to safe havens during geopolitical crises, but Bitcoin, frequently compared to gold by its proponents, reacted very differently. Its price dropped below $73,000 for the first time in months. The market impact was immediate. In the 24 hours following the strikes, $1 billion in leveraged crypto positions were liquidated as prices plummeted. Data shows that 93% of those losses belonged to retail traders who had borrowed money to bet Bitcoin would go higher. They were caught on the wrong side of the geopolitical trade. This rapid loss of capital has driven retail market sentiment into a state of extreme fear, triggering further waves of selling from individual holders. However, a closer look at the behavior of major financial and political institutions reveals a distinct contrast to this retail panic. Integration into U.S. policy began in 2025, when President Trump issued an executive order to establish the nation's first strategic Bitcoin reserve. Currently, this reserve functions as a repository for assets seized from criminal activity, meaning the federal government is now a major holder, albeit through law enforcement actions. Financial analyst Cathie Wood suggests this strategy could shift toward active purchasing. With the 2026 midterms approaching, the administration has a political incentive to formalize its crypto policy and deliver on promises to the digital asset community. This political momentum is mirrored in Congress, where the Clarity Act is moving through committees.
For years, crypto firms have operated in a regulatory gray area, struggling to determine if their products fall under the jurisdiction of the Securities and Exchange Commission or the Commodity Futures Trading Commission. The Clarity Act proposes a set of definitions designed to resolve this jurisdictional battle once and for all. These legislative and executive efforts signal an intent to normalize Bitcoin's place in the American financial system, moving it away from the legal uncertainty that has historically defined the asset. On Wall Street, that normalization is already well underway. Van Eck recently launched a spot ETF for the BNB token, expanding the roster of crypto assets available to any investor with a standard brokerage account. To serve institutional clients, the CME Group is shifting Bitcoin futures to 24/7 trading. A standard 5-day trading week expands into a continuous loop. By eliminating the weekend gap, Bitcoin now trades around the clock alongside mature global commodities like oil and gold. At the same time, the physical infrastructure of the network is pivoting. Major mining companies are currently outperforming the asset itself on the stock market. These companies are leveraging their massive power connections and cooling systems to double as AI data centers. By hosting artificial intelligence workloads, they have diversified their revenue beyond simple coin production. Between regulated ETFs, 24-hour futures markets, and the pivot to AI infrastructure, the technology has been integrated into the long-term business models of major tech and finance firms. The crash of May 2026 was a violent shakeout of leveraged speculators, but it did little to slow the institutional build-out happening behind the scenes. While retail traders were exiting the market, the government reserve remained in place. The Clarity Act continued its advance, and Wall Street expanded trading pipelines. Bitcoin is no longer just a speculative experiment for the internet. It is now supported by the same regulatory and physical infrastructure as the rest of the American economy. With the asset now woven into federal policy, retirement accounts, and the nation's energy grid, the central question is no longer whether it will persist, but how these institutions will choose to use it.